Hello everyone, my name is Radovan Vojtko. I'm CEO and the head of research at Quantpedia, and today we will discuss gold. I will probably not say anything new if I mention that gold is really popular right now. So at the beginning of the year 2026, we are nearing the price of $5,000. The main reason for that is because there is significantly higher geopolitical risk. So users like to buy the gold when there is a risk of something happening, especially from the politicians. And all of the steps that current President Trump is trying to do makes this precious metal very popular. So some of the people like to hold gold as a strategic asset allocation. So what does it mean is that you buy it and you hold it no matter what. It's not a bad idea if the gold is not very high percentage of your portfolio. But if you would like to increase the percentage of your portfolio which is dedicated to gold, it's a good idea to have a tactical model. So to have the model that will tell you when to buy the gold and when to not hold the gold, buy some different assets.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
So we looked for some very simple price-based regime model for gold. We tried different things, but at the end we settled by using just the price. The advantage of using the price is that it's simple to obtain and you do not need to use all of the macroeconomic indicators like inflation, unemployment, etc. When you use the price, the models are usually simpler and they are sometimes more robust. That's the reason. So our main motivation was to find the model that will help you to guide when to hold the gold and when to hold a different asset class. And we used two different predictors. First one was the price of gold itself, which is like the logical, and the second one was the total return of the treasuries, some treasury index or treasury ETF or something like that. I will later get to which ETFs are using, why we are using the gold and the long duration treasuries. Using the price of gold itself is natural, it's called trend following. So if the price of the gold is trending up, you will buy the gold, and if the price is not trending anywhere or going down, you will try to get out of the gold and holding something different. So this is like usual trend following, but by using the treasuries. So there is a special regime in which the gold really performs well, and it's when you expect that the real yields will stay high. And when are the real yields staying high? It's when the inflation is high or there is a high geopolitical risk, but on the other hand the treasury yields are going down. So when you have the simultaneous positive momentum in the gold and long duration treasuries, this is the best regime. We can call that as falling real rate regime. It's consistent with the heightened demand for safe assets. So there is high recession probability, there is an easing dominant monetary environment. In contrast, when we have the other adverse regime, when we have the simultaneous negative momentum in the gold and long duration treasuries, then we have the strong performance of the pro-cyclical asset classes such as broad equities, industrial commodities, value, financial sectors, high yield credit, etc. We can very easily identify when there is a regime which is better for the gold and when there is a regime which is better for assets which are highly cyclical, financial companies or IT stocks or whatever. Firstly, so we obtained data for a GLD, which is a gold ETF, one of the biggest one, and the IEF, which is the iShares 7 to 10 year treasury bond ETF. We are using the total return data, so data which includes the dividends and adjusted for stock splits or for ETF splits. That's how we do it. When we do not have the underlying ETF, because those ETFs started in 2002 or 2004, we are using the total return indexes. So our analysis starts in 31st December 1969 and it ends in September 2025. If you are curious what is the current model showing, it's still showing buy the gold. So we are still in the same phase, so buy the gold. Why we are starting in 1969? That's the end of the Bretton Woods, not exactly, but plus or minus, and the gold price starts to move, because for that the gold price was fixed and it doesn't make a lot of the sense to buy gold because monetary policy was very tightly connected to the price of the gold, and after the Bretton Woods the price of gold was allowed to move freely. There is a good idea to start trading the gold because it can move very fast. So this is the length of the horizon. So we are used from 1969 to 2025. And what is the methodology? So firstly, let's have a benchmark. So the buy and hold allocation to gold, a simple buy and holding of the gold is the benchmark. So what is the performance? The gold has a very interesting performance, over 7% with the 18% volatility, maximum drawdown 60%, which is not low, and Sharpe ratio 0.4, performance to maximum drawdown 0.14. It's similar to equities, a little lower drawdown, little lower performance, plus or or minus the same volatility as the stocks. The gold is usually having the same performance as the inflation, or is outperforming inflation a little. However, I mean, as you can see, there are some periods when the gold has very strong up movements, and there are 20-year periods when the gold is doing nothing. Then we have once again the strong up movement in the gold, once again the period of the 10 years when the gold is doing nothing, or 15 years, and once again a strong uptrend. So I mean, the gold is trending, but the trends are very long. So it's not trending on monthly or 6-month period, it's trending on yearly periods. So this is our benchmark. We are trying to beat the benchmark. So at the end, we are trying to have the model which has the better performance or better performance and risk ratios. So baseline predictors. Firstly, let's use the gold momentum as a predictor of future gold returns. So we can use the momentum from 1 month, 3 months, 6 months to 12 months. We can average that. So we will have a model that will have 4 parts, and each part will be managed by a different momentum length. What are the results? On average, we have a little lower performance, but significantly lower volatility, better Sharpe ratio, lower drawdown, better performance to max drawdown. So we can use the trend following. This is not important whether we use 1 month, 3 months, 6 months, or 12 month momentum in our trend following model. How does the opposite look like? When the gold momentum is negative, we can see that the performance of the gold is not really interesting, so something like 1%. Okay, then we can use the treasury momentum. We will use the strong trend in the treasuries to predict the price of the gold. So I mean, if there is a strong trend in the treasury prices, we will buy the gold. It's like a cross asset momentum. So we are using the signal from the other asset and we are timing the gold. So in our case, long gold when the past performance of the EF is positive, total return performance, and flat otherwise. So we can see that if the performance of the treasury is positive, the performance of gold is mostly also positive. Once again, performance around 7%, volatility is around 14%, nice Sharpe ratio, small drawdown, nice performance drawdown ratio. And here is the opposite signal. So I mean, in case the performance of the treasuries is negative and we will try to buy the gold, we can see that our average performance is around 1%. So once again, this is the bet regime. And let's use the joint momentum states. So let's combine the momentum in the gold and momentum in a 7 to 10 years treasuries. So we have the aligned positive momentum in both of them. And here are the performance numbers: 1 month, 3 month, 6 month, and 12 month. The 12 month is the best one. So the 12 month momentum in both the gold and treasuries gives us the best signal. So we have higher performance than just holding the gold itself. We have lower volatility, better Sharpe ratio, lower drawdown, and better performance to a maximum drawdown. We are improving all of the characteristics when we are using this model. And all of the other combinations, so when the gold is positive and total return of the treasuries is negative, or gold is negative, total return of the treasuries is positive, or when the gold is negative and treasuries are negative, have significantly lower performance, and you will not like to hold the gold in those regimes. So there is only one really jointly positive regime, and it's this one. So when we have the 12-month gold performance positive and at the same time the total return performance of the treasury is positive, this is the best regime for buying the gold. In this case, you can buy safely gold. If you are not in this regime, you can hold other assets. So you can buy cash if you want to be really safe, or you can look out for some risky asset, buy some equities or whatever. So here is the performance with the cash if we are holding the gold and the regime is positive for both treasuries and gold. And in other case, we hold the cash, we have even higher performance, lower volatility, Sharpe ratio 0.8, which is a really interesting, lower drawdown, and a better performance to max drawdown. So I hope that you like this model. It's very simple on a monthly basis, just 2 predictors, just price based, and it has very interesting capabilities. So it will give you a nice technical model when to invest into the gold, because as we have seen before, the gold is really trendy asset. So when there is a trend, the trend is for a long time, and when there is no trend in the gold, you can hold the gold for 10 years and you will earn nothing. So it really makes sense to not hold the gold strategically, but take a look on it from the practical point of view. So really hold the gold in the portfolio only when it makes sense. So I hope that you like the article. If you like the article, please come to our webpage, subscribe to Quantpedia, subscribe to our newsletter. We have over 1,000 strategies in our database, so you can subscribe to Quantpedia Prime, Premium, Pro, and you will get hundreds and hundreds and hundreds of trading strategies with the code, with the backtest, and you can easily use them in your trading. So thank you very much, and I hope that you will join me in the next video.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.